What's going on? Alex here, and today I'm answering your tax questions from Reddit. And today's question has to do with estimated payments and how the safe harbor for estimated payments can help you to avoid tax penalties at the federal and or state levels. So we're going to check that out in a second. But first, I want to thank you guys. Over 7,000 subscribers or something very close to it, and over 500,000 views. I never thought this little YouTube channel would get to even these numbers. So I wanted to show my appreciation, tell you guys thank you for all of the support, everybody who subscribed, commented on the videos, liked the videos. I see all the comments, and it's just that over the past few months, we've been extremely busy with new clients coming in, with different developments, new offices, new employees, things like that. So there's been a tremendous amount of growth. And with that, there are going to be some exciting things coming. So thank you so much. If you're not subscribed already, feel free to subscribe. And with that, let's take a look at the question. All right, so this question comes from Justin Jakes, 24, and goes as follows. Quarterly tax question. So I'm supposed to file quarterly taxes this year because I'm self-employed. I'm making significantly more money this year. Congratulations. But I heard I can take what I owed last year and divide that by 4 and make the quarterly estimated payments. Am I understanding this correctly? Do I just take my 2021 federal tax, divide that by 4, state tax divided by 4, submit those quarterly, and I'm good? This is a great question. And while in some ways it is that simple, in other ways it's not that simple. And we're going to get into a bit of detail as to why. So the estimated payment safe harbors were put in place to allow taxpayers to essentially plan their tax payments for the upcoming year using amounts from the current year. So we might be talking about using amounts from 2021 to plan your estimated payments for 2022. So how does that work? We're going to take a look at it in a bit more detail, but essentially you are establishing the baseline for the estimated payments that you're going to pay in that upcoming year based on the prior year numbers. That doesn't mean that in the upcoming year, that's going to be your actual tax liability. What it really means is that you're going to at least pay in enough in that upcoming year based on the prior year to avoid the assessment of penalties and interest for failure to make timely estimated payments. So how does all that work? Let's take a look. I have a tax return pulled up here, and essentially all we did here was put in a single taxpayer, and there's not much else going on except $100,000 in self-employment income on Schedule C. All right, and the way that's playing out on the tax return is essentially we have the $100,000 right here, and it's resulting in a tax amount of $24,029. So the way the estimated payment safe harbor works at the federal level, now it's very important to separate federal and state. At the federal level, essentially, if your AGI, or adjusted gross income, which is found on, let's say, your 2021 return, is less than $150,000, okay? So in this case, the adjusted gross income on line 11 is $92,935, and this is from the 2021 Form 1040. So with that AGI amount, we're below $150,000. So what we get to do is use 100% of the 2021 total tax, which is on line 24, and use that as the baseline for what the estimated payments should be in the upcoming year, being 2022. All right? Essentially, you are multiplying this 24,029 by 1.0 because it's 100% of this year's tax, being 2021, setting the baseline for the upcoming year. What's going to happen in 2022 is even if your income increases significantly, as long as you make this much in estimated payments that are made timely and withholdings, so estimated payments and withholdings together, if each quarter you're adding up to at least 1/4 of this 24,029, then you're going to avoid estimated payment penalties. Now, you're going to owe the additional taxes once you file your returns for the upcoming year, being 2022. So the extra tax doesn't go away. It's just that you're not penalized for not making timely estimated payments. So in this case, we actually have an example of what this would look like. So let's say in 2021, this is your tax return with the $100,000 in income, and the total tax amount in line 24 is 24,029. So we actually set up the software to calculate what the estimated payment safe harbors would be for 2022. Now, you could see that we set this as 100 and 110% of 2021 tax. And I'm going to talk a little bit about what that 110% means. That's also very important, especially if your income exceeds the 150,000 that I mentioned previously. But let's stick to this for now. 100/110% of 2021 tax for federal, and for state, 100 and 110% of 2021 tax. We're pretending this taxpayer lives in the state of California and also earns income within that state. All right. Going to what we refer to as the client letter, this kind of spells out to clients directions for payment of tax and estimated payments and so forth. You can see here that there's the 2022 estimated tax payment schedule that's provided. So it has the dates listed here. These are the dates by which those payments may be made timely. Those are the deadlines for those payments. And at the federal level, you'll see that we have $6,008 constituting every payment. And 4 payments of $6,008 add up to $24,032. Now, where's that number come from? It should look familiar because essentially it's the amount of total tax that we obtained from the 1040 of 24,029. There's a slight rounding error there, but essentially that's what that number is all about. And just to prove that out, we could take 24,029 divided by 4. We have 6,007. It rounds to 6,008 essentially, and that's what we have on the client letter. All right. So you'll see that it's playing out differently at the state level as well. We're going to get to that in a second, but let's see what happens if we increase the 2021 AGI to exceed 150,000. All right, so let's go to the self-employment section here, and let's drop in, instead of 100,000, let's do 200,000. Okay, so what happened? Let's look at our return. All right, and all that really changed is the income went up, and of course, for 2021, the total tax is going to go up too, right? And we see on line 24, that amount now is $52,251. All right. So looking at the example with AGI below 150,000, we would expect just to be able to take 1.0 of this in terms of multiplication and get the estimated tax payments for 2022, being that it's 100% of the 2021 tax. But when the AGI is over 150,000, which in this case, let's just confirm that it is. Line 11, AGI, 188,468. So now we've exceeded that 150 AGI threshold. So what happens with the estimated payments is instead of 52,251 for 2022, we instead will find that the estimated payments are 57,476. What happened? Well, when the AGI exceeds 150,000, as it does in this example, instead of multiplying the total tax by 1.0, as you would if the AGI is below 150,000, if it's above 150,000, you multiply it by 1.1, or 110% of the current year tax. Let's do the math. All right, so 52,251 times 1.1, we get 57,476, and what did we have on our letter? 57,476. That's close enough for me. So what we're seeing there is that if your income, specifically AGI, exceeds the 150,000 threshold, then you have to account for 1.1 or 110% of the total tax of the prior year in estimating your payments for the next year if you're going to utilize the safe harbor. So that's at the federal level. It's essentially two ways that it can go. If AGI is below 150,000, then you use 1.0 or 100% of the total tax in the current year to estimate your estimated payments for the upcoming year under the safe harbor. Now, if your AGI in this year exceeds 150,000, then you have to use 1.1 as the multiple or 110% to get the estimated payment safe harbor amounts. Now, if there are withholdings, this is done a little bit differently, but very basic idea is that it's either 1.0 or 1.1 as the multiple that you use. Now, on the state level, this can vary significantly. Now, in a very basic situation, let's change the income back down to 100,000. All right, and let's look at the California side of things, because California always has to be different. So on the California return, we see that the AGI is below 150,000. So it's 92,935. We see California adjusted gross income. And let's look at the total tax amount here on page 3, and we will see that it is $5,067. All right, so let's look at what the estimated payments are calculated to be on our client letter. It's $5,069, which is a rounding error away. But you're noticing here that the payments are not even. What's the deal? Now, unlike what's simple and logical, California always has to be different. So they can't make anything simple. And instead of the federal estimated payments, which are paid in 25% per quarter, so 25%, 25%, 25%, 25% on each one of these payment dates, California does it differently in that on the first quarter, and let's do the math here, they want 30% of the tax paid in, not 25, but 30. So we take the total times 0.3, we get 1521. Okay? Now, the second payment, California still doesn't want 25%. They want 40% of the tax. Okay? So you take that total amount and you multiply it by 0.4. There's your second payment. Now you're thinking California's pretty greedy. For the third payment, they're going to want some astronomical amount. Not exactly. For the third payment, they want 0. All right? So you'll see that that third payment is 0. And if we calculate that fourth payment, it's going to look very much like the first because it's another 30%. So you have 30%, 40%, 0, and then 30%, which adds up to the 100% that you get on the California side of things. All right, so the dynamic works the same way in terms of the $150,000 threshold, in that you have to use 1.1 as the multiplier to calculate what those safe harbor payments would be. So let's test that out. Let's change the income to 200,000. Let's pull up the California return. We see that the California AGI, again, you can't use the federal for state purposes. States usually have their own AGI amount, so keep an eye out for that. But the California AGI is 188,468. Are we above 150,000? Yes. Okay. So in that case, we have to take the total tax and multiply it by what? 1.1, 110%. All right. So let's do the math on that. So we have 13,954 times 1.1, because AGI is over 150,000. We get 15,349. So let's see what our client letter says. All right. And we have essentially 15,349. It's 15,350. It's just a rounding error. Now, let's test our 30% and 40% allocations for each payment. So times 0.3, we have 4,605. Okay. And then times 0.4, we have 6,140. So again, 30%, 40%, 0, and 30% gets you the 100%, which is how it works at the California level. They have to be very careful with California because they have additional stipulations, especially if income exceeds $1 million, and that you cannot even use the prior year as a benchmark for what the estimated payment should be. You have to use that current year. So 2022, you have to use as a baseline. You don't have the option of using 2021 amounts if your income is especially over $1 million. So keep an eye on that. And each state basically has its own quirks associated with how they want their estimated payments made, both in terms of the payment dates and the payment amounts. So don't assume that you could simply take 25% of the total tax amount for the year and call it a day, because especially at the California side of things, you can end up underpaying on one or more of those dates, which will result in penalties and interest being assessed, believe it or not, even though you're paying it quarterly as you go. So definitely something there to keep in mind. The federal is a little bit more straightforward. You just have to think, okay, is this going to be 100% or 110%? Am I going to multiply the total tax by 1.0 or 1.1? A lot of the guessing is taken out of the equation on the federal side. Now, on the state side, anything goes, especially California likes to be very tricky with this stuff. So definitely be careful there. And in terms of taking a step back, you have to also consider that these estimated payment safe harbors work well when income, let's say in 2021, is expected to be low, and the income in 2022 is expected to be a lot higher, because relying on the 2021 estimated payment amounts works really conveniently, because you'll pay less than you would if you were just basing it on 2022, and then you pay in the balance when you file the 2022 return. No penalties and interest should be assessed in that situation. But what if income goes higher in 2021 and then lower in 2022? Well, now if you base your estimated payments on 2021, you're going to end up overpaying significantly, right? So in those situations, the estimated payment safe harbors don't help as much as they do in years where income from, let's say, 2021 increases in 2022. If 2021 is going to be $100,000, 2022 is going to be $1 million, then the estimated payment safe harbors work really well. If 2021 is $1 million and 2022 is $100,000, the estimated payment thresholds don't really help you all that much, and it's usually good to put estimated payment projections together to figure out what you should pay in 2022 if income is expected to be lower than it was in the prior year. All right. Another thing that I'll add is that withholdings, and there's an article on this in the Tax Advisor, which is really helpful on the topic. Withholdings have this magical ability to be deemed as having been paid evenly throughout the year, unless the taxpayer establishes the dates on which the amounts were actually withheld. So with withholdings, they're even more powerful than estimated payments, because you can have withholdings taken out on December 31st, and it counts for tax purposes as those withholdings being taken out evenly throughout the year. So if you have, let's say, $10,000 in withholdings taken out on December 31st of a particular year, for estimated payment purposes, it counts as $2,500 in Q1, $2,500 in Q2, and so forth. So sometimes there are opportunities to increase wages at the end of the year with substantial withholdings, and that will help overall to mitigate penalties that may be applicable for estimated payments. So that's kind of a little trick that we use sometimes. And when entrepreneurs that we work with haven't made the estimated payments, this is one way that we can even things out and get out of that penalty area. So just something to keep in mind there. And there are also some little tricks that can be used that are outlined in this article. If you're curious about that, it's called Strategies for Minimizing Estimated Tax Payments. This was an article that came out in the Tax Advisor in March of 2018, so definitely check that out. So let's make sure we actually answered the question after all of this good stuff. Do I just take my 2021 federal tax, divide that by 4, state tax, divide that by 4, and submit those quarterly and you're good? Sort of, but not quite. All right, so for the federal side of things, it depends on your AGI from the base year. For example, for 2021, if your AGI is over 150,000, then you're using 110% or 1.1 as the multiplier for that tax amount for the safe harbor. Dividing it by 4 is a pretty safe bet at the federal level, but at the state level, that all falls apart. We saw that. Every state's different, so keep that in mind. And the state tax divided by 4, that's in many times not going to work. So read your state's instructions, see what's there, and they'll commonly have some really good guidance in terms of how to time those payments and what amounts they should be in. And are you good? Well, if you follow everything that I just discussed in this video, then you shall be good. All right, so Justin Jakes 24, I hope this was helpful. Now, if you're watching this and you haven't subscribed to the channel and you found value in this video, definitely feel free to beat up that like button as if it looked at your girlfriend the wrong way. And with that, we're going to keep this thing chugging along. We got some big plans for some amazing content that we're going to put out for you. So stick around, stay tuned. If you have questions, drop them in the comments below. And I see your comments, and I love you and I miss you too. All right. So the idea is to get to a point where we're doing this on a more regular basis and no more 7-month breaks. Okay. That's ridiculous. Right. All right. So hopefully this was helpful. Thanks for watching.